2019 in the retail market from the second quarter was very similar to what's been happening throughout the retail market in the most recent quarters that we talked about.
2019 Q2 update for the industrial market, really broken down into a couple different sections. Looking at it from the sales side, sale activity continues to be strong. There's been still a high demand, especially in that 20 to 50,000 square foot range. A lot of this is a result of there being a plethora of capital that's available.
There are great opportunities for landlords and sellers in Holland as the tenant and buyer demand is very strong.
In the investment market, there's a lot of activity across the board with industrial and office Class A product really creating the most demand. In general, the office market has been super strong, probably the best we've seen in about 10 years. Vacancy rates, both downtown and suburban, are now below 10%. We haven't seen that occur in quite some time.
Where we've seen the most amount of activity has been throughout the 28th Street corridor. Most notably, the transactions include the Cooper's Hawk that's being built across from the Home Depot, the former Carrabba's, which is now the Buddy's Pizza, which opened in the second quarter, and go on down to Woodland Mall, which includes the development with White Cheesecake Factory, Von Maur, and recently opened REI. Lots of activity has been seen throughout this corridor. We anticipate that to continue moving on to this.
It's challenging with the lack of product, the lack of inventory, but there definitely are opportunities in the ability to put deals together both from a user standpoint and an investor standpoint.
Downtown Holland has really accelerated recently with the new development. There's minimal vacancy and demand is very strong for retail space, both traditional retailers and restaurant space.
So, Grand Rapids being a second-tier market, historically has not attracted a lot of regional or national investment. But as the last couple of years have unfolded, we definitely have a lot more activity from regional and national investment groups looking to place their capital in West Michigan. So, we're seeing continued activity downtown in particular because tenants want to be in a thriving work environment. They want to have a lot of amenities within walking distance. They want to, in particular, be recruiting young people, and I think they're willing to, spend a few more dollars to find that product.
Looking at the lease side of things, as you talk about all this new construction, these spec buildings, and the lack of vacancy that there is, lease rates just have continued to rise and go up. We suspect that that'll continue to be the case, just given lack of product, construction cost, lack of available industrial land. Land costs have also gone up. All these factors are just pushing lease rates higher and higher.
In our market, we still have limited spec space being built. Most of what you see right now is all being driven by users and companies. I expect in the second half of this year to start to see a little bit more spec space from industrial, office, and land development start to kind of emerge a little bit more.